What is a rate of return? A rate of return is the net gain or loss on an investment over a specified time period, expressed as a percentage of the investment's initial cost. Gains on investments are defined as income received plus any capital gains realized on the sale of the investment. Rate of return is equal to current value minus initial value divided by initial value multiplied by 100. This simple rate of return is sometimes called the basic growth rate, or alternatively, return on investment, or ROI. If you also consider the effect of the time value of money and inflation, the real rate of return can also be defined as the net amount of discounted cash flows received on an investment after adjusting for inflation. What does the rate of return tell you? A rate of return can be applied to any investment vehicle, from real estate to bonds, stocks, and fine art. Rate of return works with any asset provided the asset is purchased at one point in time and produces cash flow at some point in the future. Investments are assessed based, in part, on past rates of return, which can be compared against assets of the same type to determine which investments are the most attractive. Many investors like to pick a required rate of return before making a choice. The rate of return calculations for stocks and bonds are slightly different. Assume an investor buys a stock for $60 a share, owns the stock for 5 years, and earns a total amount of $10 in dividends. If the investor sells the stock for $80, his per share gain is $80 minus $60 equals $20. In addition, he has earned $10 in dividend income for a total gain of $20 plus $10 equals $30. The rate of return for the stock is thus $30 gain per share, divided by the $60 cost per share, or 50%. On the other hand, consider an investor that pays $1,000 for a $1,000 par value 5% coupon bond. The investment earns $50 in interest income per year. If the investor sells the bond for $1,100 premium value and earns $100 in total interest, the investor's rate of return is the $100 gain on the sale plus $100 interest income divided by the $1,000 initial cost, or 20%. The simple rate of return used in the first example above with buying a home is considered a nominal rate of return since it does not account for the effect of inflation over time. Inflation reduces the purchasing power of money, and so $335,000 6 years from now is not the same as $335,000 today. Likewise, $250,000 today is not worth the same as $250,000 6 years from now. Discounting is one way to account for the time value of money. Once the effect of inflation is taken into account, we call that the real rate of return, or the inflation-adjusted rate of return.